This video is about how the Silicon Valley Bank collapse unfolded, what the implications are, and whether your deposits are at risk. Hi there, I'm Avanti. I'm a mom, an investment analyst, and a CFA charter holder. Subscribe to my YouTube channel and follow my Facebook page to learn how to build wealth through investing. Silicon Valley Bank was the 18th largest bank in the United States and the second largest bank failure since the Great Financial Crisis. We haven't seen many bank failures in over 10 years. Silicon Valley Bank was the bank of choice for many venture capital firms, private equity firms, as well as startups. When interest rates were near zero, the VC world saw a massive growth in deals. In 2021 alone, US VC-backed firms raised a record $330 million. The growth in VC activity helped Silicon Valley Bank grow its deposits. Between 2019 and 2021 alone, Silicon Valley Bank saw a threefold increase in total deposits. Everything was great on the outside, but there were problems internally, which began bubbling up to the surface when the Fed started raising interest rates. Here's how banks work. Small clients like you and me, or big clients like these giant VC firms, deposit money in a bank. The purpose of small depositors like us is to preserve liquidity so we can pay our bills. The same goes for large clients. They need to make payroll or pay operational expenses. The larger the company, the larger is the size of the deposit. The bank pays a small interest rate for these deposits to depositors. The bank then uses those deposits to make loans to other entities such as individuals and businesses, charging them a higher interest rate, making money in the process. Lending is not the only way banks make money. Banks also invest a portion of these deposits. Silicon Valley Bank's deposits grew 3x from 2019 to 2021, and loans only grew 2x over the same period, as can be seen by the difference in the slope of these two charts. So what do? They decided to put the rest of the money to use. Not a bad idea. So far, so good. This is what the breakdown looks like for SVB's financial assets. Loans make up 35% of their financial assets, and more than 50%, as indicated by this big chunk here of $108 billion, were treasury and agency-backed securities. Now, these are default-free securities. Treasuries are backed by the full faith and credit of the United States government, and agency-backed securities backed by government agencies like Fannie Mae, Ginnie Mae, Freddie Mac. However, if you dig deeper, you will realize that about $100 billion worth of these securities had maturities over 5 years, and more than $90 billion had maturities over 10 years. All this information is from SVB's 10K. You can find it in the section on investment securities. While these securities are free from default, they still carry interest rate risk. I discussed interest rate risk in detail in my T-bill video. Value of a bond is inversely proportional to the interest rate. When interest rates rise, bond value falls, and vice versa. Longer the term of your bond, higher the interest rate risk. The rise in interest rates is good for investment income on new securities. The ones SVB owned were bought when interest rates were lower. All was fine till inflation was low. In 2020, after COVID hit, inflation started creeping up, slowly at first, and then it was beyond control. Everyone kept saying how inflation was going to be transitory, and the Fed missed some obvious signs, such as the massive growth in M2 money supply. We haven't seen such massive growth in M2 money supply since the 70s, and even the 70s growth seems to be dwarfed by the 2021 growth. When interest rates are low, borrowing is easy and spending is even easier. Couple that with supply chain issues and prices rise even faster. Even as supply chain issues resolved, inflation stayed elevated. That's when the Fed realized it had to step in and do something. The Fed started hiking interest rates. I talked about this when I discussed the yield curve in this video, but I'll explain it in brief. When the Fed raises interest rates, it makes money more expensive to borrow. If interest rates are higher, you'd rather invest your money rather than spending it. Higher interest rates help slow the economy down. A desired outcome of raising interest rates is lower spending, which in turn should reduce inflation. Everyone was used to low interest rates, and Silicon Valley Bank kept betting that interest rates were going to drop. In April of 2022, Silicon Valley Bank's risk officer stepped down from her role, and the bank didn't have a risk officer for most of the year. The bank also allowed interest rate hedges on its investment positions to expire. The rise in interest rates had another undesired effect. VC funding began to dry up. Companies still needed cash for operations. To help with operations, companies started withdrawing more than the bank's available liquidity. In normal circumstances, a bank would just sell a few investment securities and generate the necessary liquidity for companies who need to tap into their bank deposits. However, in the case of SVB, more than 90 billion of their investment assets were tied in long-term treasury and agency bonds. To boost the bank's liquidity, SVB sold a bunch of securities at a loss. When some VCs realized that the bank's in trouble, they began tweeting about it, telling others to withdraw from SVB, which led to a mini bank run. Then SVB needed even more cash. A bank run is when multiple people go to their bank and demand their deposits back. Banks often have these deposits tied up in loans or other securities, and in order to liquidate quickly, they have to take a loss. A bank run has the potential to destroy even a large bank. Friday, March 10th, a lot of companies that banked with Silicon Valley Bank could not process their payroll because the bank wasn't able to release funds. SVB was an FDIC member bank. What that meant was that deposits up to $250,000 were insured by the FDIC. If you had an account with a balance of up to $250,000, you would have been made whole by the FDIC. Startups and VC firms, on the other hand, had a lot more in deposits, and SVB had signed exclusive banking deals with some clients, which meant they couldn't bank anywhere else and couldn't diversify their risk. Panic kicked in on Friday when these companies couldn't process payroll or make any withdrawals. There was risk of widespread contagion. On Sunday, before the international markets opened, the government took a drastic step to contain the damage. The Federal Reserve, Treasury, and FDIC announced that they would make sure all depositors at Silicon Valley Bank and Signature Bank would get their deposits back in full. If you were a stockholder or bondholder of these banks, the government will not help you. This is not a bailout. Taxpayers will not pay to recoup these losses. Instead, the Fed said they would impose a special assessment fee on banks. A major contagion was averted. Imagine you working at one of these startups that had all their money tied up at SVB and couldn't get your money back or get paid on Friday. I don't think the onus of studying a bank's financials should fall on you as a depositor. It should be the job of a regulator. How can you protect yourself? FDIC already insures up to $250,000 of your deposits with FDIC insured banks. FDIC, make sure your bank is an FDIC member. Diversify your assets. Treasuries continue to be attractive and you can learn about them here. Of course, you need short-term liquidity along with long-term investments. Finally, don't invest with anything that's on Forbes list. Just kidding. I don't think they're to blame. Understanding these risks early on requires a deep dive into a company's financials. In this case, if you had just looked at the balance sheet without looking at the supplemental information on investment securities, you wouldn't have realized that this bank was at risk. While you wait for the next video to load, like this video and share it with one other person who you want to help. I want more and more people to start saving and investing in their family's future. As always, don't forget to be happy, to be kind, and to be your best self. Bye.